If you're looking at buying a real estate investment property and you don't think you have enough cash, stay tuned because today we're going to be talking about creative ways to fund your deals. Most people don't realize that there are more funding options and alternatives available to them. And today we're going to break down 3 of my favorite. I just want to say thanks for everybody that has tuned in, that has either emailed me through the podcast or directly. All of your questions are great, and anytime I can do a video, I'm more than happy to do that. If you aren't subscribed, hit the subscribe button below, and if you have any questions, leave them in the comments below. So before we go over the 3 areas that I really like for getting creative about funding real estate, I just want to talk about the most common way to purchase real estate that, the average person knows, and that is your conventional mortgage. That's the one you hear all the time. 20% down typically, 80% is actually the debt, the mortgage component of it. What's great about these is that you can usually get the lowest interest rate or some of the lowest interest rates with conventional debt. The process is, again, very standard. They look at your credit score, they look at the income you bring in, pretty simple stuff. Now, a little bit more unorthodox than that is your unconventional mortgage. And what that simply means is that threshold, that 20% down payment, you are not able to achieve that. So say you put 10% down or 5%, any amount lower than 20. Anyways, you put that amount down, and what typically needs to happen is the mortgage needs to be insured. Oftentimes you're getting this insured by a federal agency, Fannie Mae, Freddie Mac, FHA for some of the mortgages. For the Canadians out there, that would be CMHC, Canadian Mortgage Housing Corporation. Now, oftentimes the unconventional mortgage can have a pretty competitive interest rate because, the weight of the Fed is really insuring the mortgage itself. Now, putting those aside, those are your typical mortgages. What I want to talk about today is 3 areas. And number 1, it's going to be private lending. Number 2, hard money lending. And number 3, the VTB, AKA the vendor take back mortgage. So private lending. Private lending is exactly what it sounds like. It is lending from private individuals. These can be your family, your friends, your colleagues, your mailman, anybody that actually lends money for real estate. Now, when I was first starting out real estate, I thought private lending was just not a thing that happened. People would just hand you money for real estate. And what you do realize is once you get into investing groups and you start investing personally, you start realizing that there are all kinds of individuals that lend on the private market. Now, it's going to be a little bit more expensive than conventional lending, but it also will have certain flexibility that potentially conventional lending won't have. One example is that in my area, I had somebody that used to flip homes. Now, oftentimes he would need capital to buy equipment, buy materials, and at the time he was offering a 9% return on the capital that you would loan to him. So he was using others as private individuals to loan. I had one friend that loaned him $50,000 for, I think it was 2 years. I mean, if you just look at the return, 9% on $50,000, 4,500 times 2, $9,000 over 2 years, not bad. Back then, you probably weren't going to be able to get that in almost any other investment. And what was cool is that the house flipper would actually show where the money was going. So oftentimes, if he was building a property and he was buying wood for the property, he'd show the receipt and he'd show the materials that were used. And it was just a really cool thing that I had never seen before. I didn't realize that people, would just lend. Now, there are downsides here, obviously. The fact is that you're gonna have a higher interest rate. They're typically for a shorter period of time. It's not like a conventional mortgage that's gonna go out 15, 20 years plus. Just to keep in mind, you'll also have to go to a lawyer. You have to get a proper contract drafted up between the 2 people. Now, it should go without saying, one of the downsides is if it is a family member, a friend, a colleague, and things don't go right, it could create issues in the relationship. And that's why I always say, if you're looking at partnering with friends, family, colleagues, just be very careful and make sure you go in there understanding what your interests are. And that's why contracts are so important, to clarify at the outset exactly what everybody is looking for. Number 2, hard money lending. Now, hard money lending gets a bad rap because you think about some guy in an alley that's really not on the up and up giving money to somebody. That really isn't the case for most professional people that lend hard money. Now, what hard money is the name hard. It is a hard asset that they're lending against. Oftentimes, this is used for shorter term loans. Now, if you're looking at flipping a property, you can use hard money lending to do so, as well as if you see a property that's quite under market and you're basically buying it to stabilize it and then going to a bank to have long-term financing done on it, hard money lending can be useful. Now, the people that loan hard money, they're going to be very careful to make sure that the asset if liquidated, covers the amount that they've lent you. So oftentimes you'll see them lend 70, 80% of the property value. If something goes wrong completely and they can't liquidate for that amount, they'll probably pass on the opportunity. Now, the positives of hard money lending: very flexible loan structure. The lenders of hard money typically understand the real estate business and understand the needs and flexibility of the real estate investor. So they're gonna be able to give you a loan that's structured in a way that works for them, but also works for you. A quick turnaround with applications. This is somebody that typically does this quite a bit. They'll be able to assess very quickly if they're, number one, going to loan at all, and number two, what the structure of that loan is gonna be. Some of the cons, as we mentioned, they're gonna be higher interest rates for sure. Now, these are typically short-term loans, so you're gonna wanna make sure that there are contingencies if it goes past or further than the actual contract states. Now, an additional downside is if the market turns and you are that flipper, for instance, and you realize that it's not a great time to sell. Usually what you want to do is stabilize the property to get long-term money so you can refinance that loan out so you can pay that hard money lender. Sometimes that can be challenging to do. So again, you want to stipulate in any contract that there are contingencies for that type of thing. All right, lastly, my personal favorite, the VTB, or the vendor take-back mortgage, or seller financing. So seller financing is exactly what it sounds like. You go to a property, you look to buy, say you have 20% down or 10% down for the down payment. You go to the bank, they won't lend to you for whatever reason. So then you go to the actual seller. You go, hey, Mr. Seller, I know you're selling your building. I can't get financing on it. Would you consider doing the mortgage for me, a vendor take-back mortgage? So basically that means the lender's taking back the mortgage itself. Now, people will typically say, why would a seller do seller financing if they're trying to sell the property? Isn't the whole point that they're trying to get rid of the property and get the proceeds? Yes and no. It depends on the market and it depends on the seller. If it is a really bad market and it is really hard to sell in that market, that's when you see these larger vendor take-back mortgages happen, where they want to get the deal done. Maybe it's a loan for 5 years, and after that 5 years, the investor has to pay back the owner that did the VTB. What we see that's much more common is a vendor or a seller that does a small VTB, so a percentage. So maybe you go to the bank and the bank will lend you a certain amount, and then you realize your down payment is not enough to cover everything. So the mortgage plus the down payment, you still need a little bit. That's when you can go to a vendor and you can say, hey, will you do a 5%, a 10% vendor take-back mortgage? A small mortgage to basically bridge the gap so you can purchase it. Now, my experience, that's the most common. And one thing you have to make sure is that the mortgage, the main mortgage that you have, is typically what they call in first position, and the VTB is in second position. Now, one thing you need to make sure of is that the mortgage that you do have doesn't have any exclusions that says you can't have a vendor take-back mortgage. So sometimes when you go, say from a bank, you have your, what they call mortgage in first position. Oftentimes the VTB is usually put in second position in terms of priority of payment. But some banks or some lenders will actually not allow a vendor take-back mortgage. So it's something that you need to make sure that you're allowed to do if you're gonna have both of those, a main mortgage and a VTB. Now, another additional reason that sellers will actually take a mortgage back is there are some tax advantages when you do take back a mortgage. It has to do with a deferral of some of the capital gains when you sell. But I'm not a CPA and I'm not gonna go into that here, but just a note that it's another benefit to the seller. All right, that's it for me. That was private financing, hard money lending, and vendor take-back mortgage. If you have any questions on any of those, leave a comment below or reach out to me directly. If you're not subscribed, hit the subscribe button or the little notification bell too. And if you have any additional questions, leave them below and I will get back to you. Have a good one.